Bridget Lehongwan. I will review the application using data mining of the banking sectors. For the introduction, banks use data mining to better understand market risk. Data mining applied to credit ratings and to intelligent anti-fraud system to analyze transactions, cut transactions, purchasing pattern, and customer financial data. Data mining allows banks to learn more about our online preference or habit to optimize the return on their marketing campaigns, study the performance of sales channels, or manage regulatory compliance obligations. The data mining process is often referred to as the knowledge discovery in KDD database or knowledge creations. It uses the term KDD that refers to the process of discovering useful knowledge from data, noting that data mining is a specific step in the data retrieval process. Additional steps in the KDD process are data selection, data processing and transformation, data mining, and interpretations of the result, the whole process providing useful data creations. Next, there are 4 applications in banking sector. First is in marketing, second, risk management, third, identifying and preventing frauds, and lastly is money laundering. First, I will explain about application in marketing. Data mining are often used in marketing area. Which data mining technique client can be categorized according to needs, behavior, values, and other attributes. There are 2 main models used for this classification, which is namely the credit scoring model and the behavior scoring models. This classification allows banks to launch customer-oriented marketing campaigns to each category and to offer different service and products for each category. For example, it is possible to determine how customers react to a new product or service launch, how they will react to a price increase on a particular product, or identify a customer category to increase cross-selling. Next is risk management. The most important area of application in which data mining techniques are used in retail banking is the risk assessment of lending to individuals and companies. Data mining techniques are used to quantify the risk associated with credit facility decision, making this process easier, limiting at the same time any financial losses to the bank. Data mining techniques are applied in credit decision making and help estimate the probability of non-payment and assignment of credit score notes. It can be determined as a credit behavior of borrower, which personal needs, loans, mortgage, credit card, using several variables including credit history, duration of employment, resident income amount, and marital status. The determined score allows a bank to assess the client, decide whether the person is a good customer for a loan or if there is a risk. Identifying and preventing fraud. Identifying fraud is continuing and growing concern for the banking system, which data mining technique being effective in detecting and preventing frauds. Cut are the main area in data mining fraud is highly effectively. Grouping method and cluster method are used to classify transaction and supplies value, and they will be analyzed and used to prevent frauds. Customer transaction data. There are 2 approaches used to detect fraudulent transactions. First, to identify fraudulent pattern and then referring to this pattern with their own data to detect possible frauds. Second, to identifying patterns exclusively in the bank's internal data. Customer transaction data is recorded and analyzed. Then the transaction patterns are stabilized based on the result, and if significant deviation from this pattern are identified, alert or warning about the possibility of a fraudulent transactions are generated. Lastly is money laundering, the process by which it is hidden the illegitimate income originated and their transformation into apparently legitimate incomes. In combating money laundering, data mining techniques are used to identify the suspicious transaction model that can detect money laundering transactions. The group method is used to divide and group transactions and cluster accounts from discover similarities. These methods help group suspicious transaction pattern and detect customer or account risk models. Failure to prevent and detect illegal transactions can have a major negative impact on banks, especially in terms of financial losses and reputational risks. For the conclusion, data mining is a tool enable better decision making throughout the banking and retail industries. Data mining technique can be very helpful to the banks for better targeting and acquiring new customers. The technique used are effective in many areas of application such as customer relationship management, marketing, risk management, fraud detection and prevention, and money laundering detections.